All right. Good afternoon, everyone, and thank you for spending part of your day with us. I'm Chris Ingle, VP of Investor Relations at Disrupt Equity, and I'm glad that you're here. Today's session is about two things that don't get talked about nearly enough. It's protecting the wealth you've already created and how to actually build it and build wealth that lasts, the kind that outlives you and can get passed on to generation after generation. Before we dive in, I do want to give one quick disclosure. What I am providing is educational only. It is not financial advice. It does give you a framework to ask the appropriate questions, but you should consult with your financial advisor, CPA, an attorney before making any financial decisions. With that, we will get started. There are five moves that you need to do. And the first is we need to protect our assets. Because the fastest way to lose your wealth is not through making a bad investment, it is the exposure that is led on through your structure for your investments. And the practical entity in estate moves, most people will skip. Then they're putting hardworking assets to work, and the handoff that you make to for your wealth is there can be one event that happens, and those great investments that you make over a great amount of time will can disappear. So it is very important to structure everything, and once you have the proper structure in place, then I feel that you should put your hard assets to work and build your overall wealth to eventually hand off to your heirs. And then after we have this discussion, then we're going to open it up for Q&A, so you all can ask any questions that you may have. Returns are only half of essentially what you're going to be doing to keep in wealth. Yes, you can make a lot of money on an investment and do very well. However, you need to protect that because as I did mention earlier, there can be an event that happens that essentially wipes it all out. And I do want to bring an example. You have two investors that have accumulated $1 million over their lifetime, and one of them has the proper structure in place and has the proper protections. And let's say they get into a car accident. With that one investor that did have that proper protection, their liability is only limited to a certain amount of money. That could be protected, and then also if you have the proper insurance in place, you're protecting your entire family and assets. Whereas the person who did not have that protection in place essentially has everything that they have worked so hard to build. It's open for attorneys to essentially take everything. So it's just so important to protect what you have worked so hard to build. And the thing about protection is there is layers to it, and I'm going to start with I guess, where you should start, and eventually get into some of the more structured and nuanced things. The first thing is insurance, and I'm mainly talking about an umbrella policy. And what it does is it will cover the difference between whatever the maximum amount that your insurance policy covers and what is left. And as an example, let's say you're protected for a vehicle accident for $100,000, and you lose a court case and you have to pay $150,000. That umbrella policy will, essentially cover that $50,000. And it is not very much of a cost. I was actually looking at the price of policies before this call, and you can get into $1 million or $1 million plus policy for less than $100 or $200 a year, and it can go all the way up to $5 million. So that is a good place to start. The other thing is you want to have the proper entity structure. If you have 10 rental properties, it is not a good idea to have everything in your name, in your personal name. Typically, you're going to want some sort of structure in there, and of course, you need to consult your CPA and attorney for the most efficient structure for your lifestyle. But it is very important to structure your investments properly, and that leads me into the next point: is we need to have good separation between things. I know it's convenient to have a checking account where you pay for your groceries, collect your rental payments, you have investments through there. But a minor inconvenience, I think it would be beneficial to go through that and have that separation, because on the back end, if something does happen, that could open up a lot of the liability, for you and your family. And that brings me to the last part: is it's important to have the proper titles and ownership with a property or an investment that you have. And the reason is, let's just say you own a property and then you pass away. A lot of what I have seen a lot of investors do is they utilize trust, and that eliminates the opportunity for probate whenever the person passes away, and that takes out a lot of the complication and a lot of the cost and time that is associated with it. So it's always good to have that proper title and ownership going into the investment versus trying to figure it out on the back end. And there is an old phrase, which you see at the top of this slide: shirt sleeves to shirtless sleeves in 3 generations. And what that means is the first generation typically will build the wealth. They'll have a business or investments in real estate or whatever it may be, and they accumulate that wealth through purchasing durable assets. And a lot of times, the second generation, uh, they don't they end up spending the money, especially if it comes in via lump sum. So let's just say you pass away and you leave $1 million cash to your heirs. Uh, there is a strong possibility that money will be spent, and it's important to provide a structure for your heirs to where you're kind of preventing that. And the last part of it is the third generation, which ultimately would be your grandchildren. A lot of them end up with really nothing from you. And yes, you can say bad decisions were made by the heirs, but a lot of times when you have the proper structure and protections in place, that can prevent that from happening. And it also gives you the ability to have a consistent monthly cash flow, or annually or quarterly, and it provides income to those heirs without the responsibility of, I just inherited $5 million. So if it is good to just have those assets and just have it in a way to where it is income producing, and that is how we have found, and I have found, that assets get passed on generation to generation, and yeah, that's a good form of protection. And this brings me to kind of the estate planning starter kit. So I want to eliminate kind of a misnomer with this. You do not have to be wealthy to have an estate. I think that starting out, you need to have a good plan and structure in place, and do the basics. Some of the basics could be having a will in place, having your beneficiaries up to date. Let's say that you went through a divorce or you had a child. You may want to look at that and update the beneficiaries accordingly. Also, you want to have the proper powers of attorneys in place. And once you do have that in place, I do think it is beneficial to reach out to an attorney and see if a trust fits you and your family and what you want to accomplish. Uh, it can control it. You can control your assets from beyond the grave, and this will kind of give you reassurance into essentially what it is that you want to do. And it does give a clear intent to your heirs, and you should communicate that ahead of time. And I'm jumping ahead a little bit on the slide, but it helps eliminate a lot of conflicts because, yeah, in essentially in what I do, you talk to a lot of people, and there are people that someone passed away, then they inherited, let's just say $1 million, $2 million, whatever it may be, and they are trying to be good stewards of their money, but I have found more times than not there is typically something that happens in the family, and there it always leads to arguments and more court dates. So it's just better to have a better structure in place, so you can prevent your children and grandchildren from having that. And the other thing which I think is important is you need to have a good CPA or accountant in place to help with that plan and to communicate that to your heirs whenever that happens. And lastly, I think it's so important to revisit this often. You should probably do it every few years, because life does happen and things can happen. Your opinion of some of your children can change, of course, and it's something that it's good to revisit, especially with some of the changes that you see in the tax code, and also in just some of the the structure of the trust, and however you choose to structure your investments. And now we're to kind of the case for what I would argue is great for multifamily real estate. There are four benefits, or four main benefits, for investing in multifamily real estate, and they are cash flow, appreciation, tax efficiency, and resilience. Naturally, real estate, like any other investment, it is cyclical, but more times than not, you're going to find that there is good cash flow with real estate. You need to be a long-term investor in order to realize that. If you're acquiring a property for a year or two and looking to flip out of it, then real estate investing may not be for you. It is designed for more so long-term holders, and it is something that with time will grow and increase, and eventually that cash flow will be so much that your heirs can go and purchase another property. And that leads me to my next point, which is appreciation. And one thing that we do at Disrupt Equity is we are big fans of forced appreciation. So we will purchase a property, we will renovate units, we will also improve the overall operations of that property with hopes to increase the valuation of the property, get that appreciation, also increase the cash flow, and one day sell. Although buying a property, you can hold it for 20 years, and I talked to many people that do, and most people that I've talked to that have bought a property 20 years ago, they don't regret that decision. And the next thing is that is so important to real estate investing, and I think a lot of people don't talk about it enough, is the tax efficiency that comes with it. It is, a fantastic tool. I know with the 100% bonus depreciation coming back, that is great, for multifamily investing. But I have also seen cases where people just use straight line depreciation, and they produce income from their properties and have to pay a lot less taxes, if any at all. And that is a strategy that goes on for what can go on for up to 28 and a half years. And the last part of investment in multifamily real estate that I think is powerful is it is a very resilient asset class. Is it always going to be the best investment year in and year out? Probably not. But if you look at it over a 5, 10, 15, or 20-year period, it is always solid, and there's always going to be a demand for housing. People always need to shelter, and that is something that real estate provides. And with a growing population in the markets that we operate in, the the long term outlook for real estate is just fantastic. And these are 6 questions that I think you should ask a potential sponsor where you want to invest your hard-earned money. Will it produce income that you can rely on? I think that is a very important question. And through the conversations that I have with investors every day, I think that it is more important today than ever, especially with the environment that we're in with higher interest rates and just a lot of the uncertainty that we have in the world. I think cash flow is more important to people now than ever, and it is something that a lot of people focus on. But that is more so a short-term outlook. But I do think it is beneficial to get into what will be cash flowing assets for 10 to 15 years, and maybe along that ride, there will be better times where there's just more cash flow. But I do think that is probably for me the number one question I would ask. And the other thing I would ask a sponsor, and it kind of depends on what type of investment you're in, is the overall structure of it. Is there a structure to where if something happens in my family, am I able to sell out of it? Am I able to, if I have a 1031 exchange, whenever a property sells, am I able to 1031 exchange into another property? That is something that is so important. And I have found that not a ton of people ask about it until it's probably a little bit too late. And the other thing is, I want to get to know the sponsor. I actually have investors that have flown in from out of the country to meet me, just because it is so important to trust the person that you're giving your money to and ultimately your family's money to over the next 5, 10, or 15 years. So I think it's very important to, know these people on a personal level. And I feel that meeting people in person, you get a lot better context than what somebody maybe says on the phone or a video call. And, I alluded to this earlier, but I think it's important, and this is, my personal opinion, that you need to have a long time horizon for your investments. You can, of course, flip in and out of properties, and I've talked to people that, a few years ago were making, 50% every year and numbers that are higher than that. Unfortunately, I don't talk to a lot of those people today. So I think it's important to, speak with people and it should never, an investment should never be a get rich quick scheme. I think the way that you need to vet a sponsor is, are they going to be here? What kind of infrastructure do they have? What people that they have in place? I think that ultimately is important. And if you're covering that downside risk, of course, there's nothing but upside, there because you have the proper structure and mechanics in place. And the other thing that is important is you need to be diversified with your investments. I love multifamily and I think it is a great investment. But personally speaking, I have investments across several different asset classes. And if you're looking to build long term wealth, while real estate is a great investment, as we did say earlier, it is very cyclical. And there are times where it's not performing as well as other asset classes. So it is good to have that diversification, in your portfolio. And the other part is, have I written down my intent, which ultimately means, have I communicated what my vision is to my heirs and the people in my family going forward? I think that a lot of people maybe structure things in a great way, and some people don't structure it at all. But it is so important to communicate, what's going in. And just from personal experience, I have seen people that after a loved one passes away, there's this anticipation to see ultimately what is being left to who, and oftentimes it's just not a good situation and people are disappointed. And I just think it's very important to communicate your intent long before you pass away. And this brings me to the next thing. I think that it's great to take action. If you haven't already started this, you're too late. I would call an insurance agent and see what an umbrella policy looks like and how much it costs. and explain, precisely what you want to accomplish with that. And another thing that's so important is the structure component. You need to talk to an attorney. I would also sit down with an accountant as well to figure out what structure fits you and your family and what you want to do going forward. And once you do have that foundation in place, then invest in some great vehicles, cash flowing vehicles with long time horizons with tax efficiency. And assuming that you do that every year and you have a plan that where you prepare your heirs, you will have something to leave to them and you'll have cash flowing assets to leave to them. And that will produce income for them and ultimately their children and hopefully their children's children. But the process all starts with taking action today. So it's important to protect what you have worked so hard to build. And no, I just want to thank everyone for joining me today. And it's been great, giving a small, slideshow to everyone. And no, happy to, answer any questions that you may have. Please feel free to type in your questions in the Q&A box, and I'm happy to address them. Does anybody have any questions? Well, I guess not. Well, thank everyone for joining me today. And if you do have any questions, feel free to reach out to me at cingle at disruptequity.com. You can also call me, text me at 504-884-8907. And I thank everyone for coming and hope everyone has a great afternoon.